How does asset disposal work? Have you ever wondered what happens to a company's assets when they are no longer needed? Asset disposal is a key process in accounting that involves removing a fixed asset from a company's financial records. This can occur when an asset is sold, retired, lost, stolen, or simply no longer in use. Understanding how this process works is essential for maintaining accurate financial statements and tax compliance. The first step in asset disposal is identifying which asset needs to be disposed of. Companies evaluate the asset's condition, remaining useful life, and fair market value. For certain assets, especially technology equipment, data security and legal compliance must also be considered before disposal. Next, it is important to calculate accumulated depreciation. Assets lose value over time, and this loss is recorded as depreciation. When disposing of an asset, the total depreciation accumulated up to that point must be documented. This includes calculating depreciation for partial periods if the disposal occurs mid-year. After that, the company determines the asset's book value. This is calculated by taking the original cost of the asset and subtracting the accumulated depreciation. The book value represents the net carrying amount of the asset on the balance sheet at the time of disposal. Once the book value is established, the company records the disposal transaction. This involves making journal entries to remove the asset's cost and accumulated depreciation from the accounts. Typically, the asset account is credited, reducing its value, while accumulated depreciation is debited, reflecting the total depreciation to date. Now, let's talk about recognizing gain or loss on disposal. If the asset is sold, the proceeds from the sale are compared to the book value. If the sale proceeds exceed the book value, a gain is recorded. Conversely, if the proceeds are less than the book value, a loss is recorded. If the asset is fully depreciated and disposed of without any proceeds, no gain or loss is recognized. There are also special cases to consider. If an asset is stolen or destroyed, the loss is recorded as an expense, reflecting the asset's net book value. If the asset is fully depreciated and scrapped, it is recorded by removing the asset and accumulated depreciation from the books without recognizing any gain or loss. From a tax perspective, disposing of assets can trigger taxable events. Gains on disposal may be subject to capital gains tax or recaptured depreciation rules, depending on the jurisdiction and asset type. Losses might be deductible, which can help reduce taxable income. Accurate recording of disposal transactions is essential for compliance with tax laws and proper reporting of income and expenses. In practice, asset disposal requires coordination between accounting, asset management, and sometimes information technology or operations departments. This ensures proper valuation, secure data handling, and adherence to company policies and legal regulations. Overall, understanding how asset disposal works is vital for maintaining accurate financial records and managing tax obligations related to asset sales or retirements. This process ensures that financial statements accurately reflected the current status of company assets.